Master your money, free your future. Welcome to Budget for Life. My name's Jeremy. I'm not a professional YouTuber. I'm a financial advisor. But this video is not financial advice. In this video, I want to reevaluate GameStop's collectibles business. How would we value it? Particularly given the fact that Powerpacks is being treated as equity accounting. It's an investment of GameStop's. It's not included within GameStop's operating numbers, or if you think it is included in GameStop's operating numbers, that's all as well, because either way, we're going to value the collectibles business based solely on these reported numbers. GameStop's legacy collectibles business, and we will break out Powerpacks separately as its own business valuation with its own industry peers, its own peer multiple comps, right? Its own sales growth. Very, very meaningfully different operation, Power Packs, compared to GameStop, the legacy retailer. Today, we're going to focus on valuing GameStop's collectibles line as the legacy retailer. Before I get into it, thank you to those who have subscribed. Thank you to those who have joined as fans and friends of the channel. And congratulations, another perk coming soon for fans and friends. I'll talk about it some other time. We don't have time to get into it today because we got to talk about the collectibles business, okay? So first of all, SG&A, as we did with hardware and software, we are bumping it up to a $900 million base, which I do expect to come down over time as it has for several years in a row. But for now, right now, on a trailing 12-month basis, 900 million is where they're at as far as SG&A run rate. Sales for collectibles. In this calendar year, they have done about 700 million in sales. What will they do in Q4? Well, last Q4 they did 265, and in Q1, Q2, and Q3, right down here is their Q1, 2, and 3 of 2024. They did 137, 140, and 171 in collectible sales compared to 211, 227, and 256 this calendar year. And that's despite over 1,000 store closures. So what does that mean? It means, of course, their graded card business is moving the needle for them meaningfully. And their graded card business is basically exclusively online. You can get cards graded in stores, but I'm sure that is a fraction of the revenue that GameStop makes compared to GameStop's sales of PSA graded cards on their website. And all of those sales are exclusively online. So store closures are not a big X factor here. Q1, Q2, and Q3 all saw about $80 million year-over-year improvements. So Q4, if we're talking first a floor case scenario, right? Kind of what's the worst realistic expectation for the collectibles business? If they only improve by $35 million Q4 to Q4, right? Less than half of the improvement that they saw in Q2 and in Q3, which is reasonable. There's no reason you would think that other than, well, technically the PSA partnership did exist in Q4 of last year. Now, it's not nearly it wasn't then what it is now. It was just announced back then. But I think 300 million in Q4 sales for the collectibles line is very, very conservative. I think that's basically kind of the floor expectation for the starting point of how do we talk about the collectibles business. If they make that, that would put them right at 1 billion in collectibles sales. Now, what are the margins on their collectibles business? It's a great question. So we've got collectibles here. Q1, they were about 36%, about a little climbing a little bit in Q2. Q3 actually coming down to 35%. So GameStop likely getting a little bit more aggressive on their purchasing of graded cards, right? Not just taking what comes their way from a trade-in business as far as store credit goes, but even going out to card shows and scooping up cards in bulk. right, on the open market. So a little bit of margin compression, but conservatively right now it's at 35% for, again, the legacy margins. And right now we're going to be scrapping Powerpacks out of all of these prior estimates, which, by the way, when I included Powerpacks, my prior fair value estimate was $24 million for the collectibles business. I'm assuming that will come down because we are going to value Powerpacks separately to try to get to a closer to consensus agreement on the interwebs of what is really a genuine floor, fair, and fly valuation for the legacy business. And then the Power Packs discussion can be separate, right? So anyone that wants to argue about Power Packs, that can be its own line, which admittedly is more speculative now, similar to the asset management business. More speculative now. GameStop has some startup capital and they have a startup business in Power Packs, but hopefully there's at least some consensus on what GameStop is as a legacy retailer with 30 years of data by which we can measure it. Really closer to 20 years. All that to say, do the margins continue to compress a little bit over time? Sure, maybe so, right? Let's give it a 33% margin, even though historically they're at, 36, since they just maybe are coming down to 35. Let's say they keep coming down a little bit. They're all the way down to 33% on their collectible sales. That said, the downward pressure on the margins is only existent as it relates to GameStop's ambition to scale its collectibles revenue. In other words, why did these margins come down? Because GameStop is going out and buying cards. When they are sitting back and letting people come to them with their cards and trading them in, they are getting 45+% margins on those cards. The other thing that could be dragging this down is maybe raw cards, right? TCG packs being traded at such a high volume. And those, like new unopened packs, don't have as much margin pricing power as GameStop has with the graded card business. And so again, if margins are coming down, it's only because sales are ramping, right? If TCG is stagnant and they're able to just kind of roll their graded card business very conservatively, very slowly, quarter over quarter, year over year, they're able to buy graded cards from customers who are trading them in at 40-50% off market value often. So I don't see this margin coming down to 25 or to 28%, but is there a little bit more compression ahead? Sure. But right now it's not at a 33. It's definitely higher than 33 right now. So what's the income associated with that? If they're only making 33% margins and we assign them 33% of the SG&A, that would mean they're only clearing 30 million in income from the collectibles business. The growth, though, on this business, relatively high. I mean, what we're seeing so far, right? Collectibles business growing 30+% year over year. Now, can they continue that for another year, or is this kind of a one-time bump in growth rate related to a new line item, right? Graded cards that wasn't available the year before? It's a relevant question, but also when you think about collectibles sales per store, right? You see that explosive growth that much more. The total number looks more modest because they still have stores in France that don't sell graded cards. They still have stores in Australia, stores in Canada earlier on this year that were not even a part of the PSA graded card business, right? That's only for the US consumer. And so your total collectibles numbers are more suppressed, but as they close out some of those international locations, you see that the sales per store, right? Basically the US collectibles sales is growing really at pretty impressive rates. All that to say, if we give it a continuation at a 20% growth, right? So not maybe another year of 50%, right? And then maybe coming down to 15 eventually, right? But the sector growth of the collectibles industry, right? The graded card industry is very much a tailwind. So you have the sector tailwind that is growing. Could that invert? Could that change in the future? Sure. Just like the downtrend of software could change in the future, right? But the uptrend of collectibles is very presently real and shows no real signs of slowing down. And fundamentally, the driver for collectibles is inflation, right? The fundamental value for collectibles, for graded cards specifically, is store of value. And store of value fundamentally becomes more and more important the weaker and weaker that fiat currency becomes internationally and domestically. And so, is there any reason to think that the demand, the secular tailwind for the collectibles market will decline? No. Is it possible? Sure. But to assign a low growth rate just because you are wishing upon a star that GameStop's demise occurs is silly, right? If it stops growing, we'll be able to see it, right? Um, but what was I wonder what okay, so what I had this at was 30% growth for 5 years and then 11%. The reason I'm going to leave this here is because on my projections tab, I mathed out the PE associated with this specific growth rate. We'll think about if it's accurate here again in a second. But down here, assigning a multiple to the collectibles business, I said, well, hey, if the S&P is at a 31 average PE and the earnings growth is on average 11%, then what do we have for GameStop's collectibles business? So in the floor scenario, right, 30% growth. Well, let me finish the thought with the S&P. Basically, in 14 years, if you bought one share of the SPY index, in 14 years, the SPY will have produced the earnings of the cost of your one share. So with a fast-growing business, I assumed an investor would want to break even sooner than 14 years. And so I have in 11 years, right, 3 years sooner of a break even would imply a PE of 45. Present value, if there's 30% earnings growth, followed by then 11% earnings growth. Is 30% reasonable? I think it is because, again, we're talking about earnings. We're not talking about 30% revenue growth. And the reality is that there's a lot of continued cost cutting and increased efficiency earnings still to come for GameStop, right? This is not 300 million of SG&A is not a floor at all. All of these sales are online, not all of them, but much of these collectible sales are online. And yet this collectibles business is having to front 300 million of SG&A that's largely tied to physical stores, which there will be fewer and fewer of in the coming years, right? Not to mention, again, all the international presence that doesn't even carry the graded card market. And then when you think about expansion down the road, it's like, well, their graded cards just started, and also they're still available only in the US. What if they continue to store them in the US, but eventually they have the ability to ship internationally, right? There's a lot of obvious global expansion that could happen within the graded card market. And if the sector is growing at 15%, right? Or at 12% or at 10%, right? If the sector itself is growing, then GameStop itself only has to grow marginally as it relates to its personal position within the industry. And GameStop's ability to grow its position within the industry is still very high. Again, this is not a saturated business. This is not, they've done all they can, right? They have cards now on their website. That's all there is to it, right? There's very, very many levers of growth still to pull for collectibles. And yet, I'm still modeling in this floor case scenario a sharp slowdown in the growth from what they've already seen, right? From what they're already doing. But on a multiple basis, that makes this a $1.3 billion business, right? If it's only clearing 30 million in income, but you imagine 30% income growth for 5 years, followed by 11% income growth. Let's go. And what are the odds of this? I think 10% is probably fair. It's probably fair. I think the assumption of the sales is low. Obviously, from a trailing 12 month or from a, trailing 9 month plus future 3 month, that is the starting point. But to think that these sales numbers are somehow capped, obviously, like this, the top line is going to grow. The margins have not shrunk this far, right? We're giving some money away from margin. SG&A has been coming down for 4 years, so should come down meaningfully, right? SG&A for collectibles could come down $100 million just in the next 12 months. If it comes down $100 million, guess what that does to your income? It goes from 30 to 130, right? Just from the $100 million of SG&A cost cutting. And if it's 130 instead of 30, well, at a 45 PE, that's almost a $6 billion business instead of a $1 billion business. And that's without any margin improvement. That's without any top line improvement, right? So again, this is a very floor case scenario in my mind that I would assign a low probability, a 10% chance, unlikely that this is all that GameStop is able to accomplish within their collectibles business. Now, fair case. So, fair case, if they continue to grow in Q4, just like they did from Q3 to Q3, Q2 to Q2, Q1 to Q1, then you would expect this to be closer to 1 billion plus 50 million. Oops. The margins, let's say they stay at 35%, right? So not continuing to come down, but kind of steadying around 35, which is where it's been historically as well. If we want, we could even say 34%, but I don't know why I would dock them from the margins they've been able to accomplish. They're still over 35 and they've been over 36. So calling it 35 feels fair, and projecting continued margin suppression feels a little harsh. But and again, if you want to project more and more margin suppression, it just means you're baking in more and more growth. So maybe, let's just say it comes down to 34.5, a little bit more suppression to come on a trailing 12 month. What's the income associated? Now you're looking at clearing 62 million of operating income net of their SG&A. If they grow at 40% for 5 years and then at 15%, that feels a little, I kind of want to come down a little bit on that assumption. But let me go ahead and show you the model of how you value the PE there. In this fair scenario, 40% growth followed by 15% growth. I had them breaking even in 10 years rather than the average being 14 years. Right? The S&P investment, an S&P 500 investment, you break even in 14 years. That's how many years it takes for your for what you bought to have generated the cash that you paid for it. So a faster growing vehicle, again, 40% growth for 5 years. Earnings growth. I'm not talking top line growth. And a lot of that will be achieved just from cost cutting, much less the expansion of their business. But we know their business is expanding from a top line perspective on the collectible side. And we know their costs are coming down from an SG&A perspective. So when you stack those things together, it inflates this earnings growth quite substantially. I kind of want to say, like, what if it then settles at, I don't know, like 13% instead of 15%? And my guess is that a 55 PE is still accurate, but maybe we could call it a 52 or something instead. Year one, two, three, four, five. What if we did just call it a 50 and see what that does? Then you're looking at a $3 billion collectibles business. Now, on the fly case, and I'll think about the probability here after I look at the fly case. So, fly case, if Legacy Collectibles goes off in Q4, I mean, could we be looking at basically an 1,100 million or 1.1 billion in sales to start out? Sure. Can we give them the 35% margin or maybe even 36? Just like they accomplished in Q1 and 2. Wow, interestingly, that also comes out to $96 million of net income, just like the fly case for hardware. That's funny. The growth rate here, 50% for 5 years and then settling at 19%. So let me bring down this 19 to like a 16. And as a result, again, I'd have to actually finish doing the math here on the fly case. But again, I had them breaking even in 10 years. Since we're assuming pretty high growth, I'd say let's break even sooner than that. Call it a 75 PE. And again, this growth rate, like 50% growth in 5 years sounds so aggressive. But again, if you imagine that 300 becomes 200 in SG&A and that 200 eventually becomes 150, well, that is 200% growth right there, right? Like off the jump, not quite 200, but like a huge portion of this growth is already achievable from cost cutting, and then only some of it is achievable through GameStop's expansion of their offerings and from um this sector continuing to grow. Obviously, where it tapers is very much a sector conversation. So does the collectibles business taper closer to 10, 11, that then GameStop can continue to operate efficiently to turn that into 12, 13? Does the sector end up growing at a 12 or 13 that GameStop, through its operations, can turn into a 16% earnings growth? Right? What is the long tail for the collectibles business? It's a great question. In this case, you're looking at a $7 billion legacy collectibles business. Now, do I want to change the probabilities here? I think probably, just because there's so much cost cutting ahead, even if I called this 35%, yeah, that's a $1 billion swing right there, whether it's 35 or 36. But it was 36 for a good part of this year. So again, is that insane to imagine? No, it's not even imagining, right? It's just, do you think the blip down to 35 was an aberration and that 36 is the more consistent long-term number, or that they'll be able to claw their way back to a 36, right? The 50% growth number, again, so much that's very accomplishable. I kind of want to say maybe 65 and 25 is probably fair. It's probably fair. I like this, okay? So you end up with a $4 billion legacy collectibles business on top of a $1.2 billion hardware business, putting you at 5.2, on top of a $2 billion software business, putting you at $7.2 billion, is kind of the fair weighted average valuation for GameStop, the legacy retailer. 7.2 billion. Then you add in however you value Powerpacks and however you value the asset management business. But at the very least, you would add in their net cash, which is a little over 5 billion, right? Where are you, net cash? Yeah, 5.1 billion in net cash in Bitcoin. 7.2 plus 5.15 puts you at a $12 billion kind of fair valuation if you don't value Powerpacks and you don't value the asset management, right? You don't value any of that. You're only looking at GameStop, the legacy retailer, and you don't value the eventual ultimate conversion of the convertible bonds, right? This debt will in all likelihood be converted, which we will reassess soon. You're looking at a $12 billion fair. Worst case, you're looking at a 1.45 plus 1.34 or 35. Worst case for GameStop, the retailer, you're looking at a $2.8 billion valuation. And then again, if you wanted to value just the net cash, you add in that 5.2 and it's an $8 billion market cap. If you didn't value their asset management business at all, if you didn't value Powerpacks at all, and if you didn't value GameStop's convertibles on this debt. This is not debt that GameStop owes as a traditional loan. This is convertible debt, right? You also, in this scenario, are not valuing the warrants at all. But let's think about it for a sec, because in this worst case scenario, we show GameStop clearing 30 million plus 6 billion plus 168 million. 168 plus 36. It's 204 million that GameStop is clearing in income per year, plus their interest on their cash and gains on Bitcoin, which on average will probably level out somewhere around 100 million a quarter because their cash pile is growing as well. And I don't expect Bitcoin to stay suppressed forever. So if you're looking at basically 600 million per year in cash generated, net income, right? Not just free cash flow, but net income of 600 million per year in kind of your worst case floor valuation. Well, 600 million times however many years before the convertibles are due. It's like, even in this worst case scenario, do you end up with a conversion or do you end up with dilution, right? Do you have to pay back the cash or not? Even if you didn't, 4.5 years, 600 times 4.5, that's 2.7 billion in cash generated before this 1.5 cash needs to leave. So again, when you think about the floor case scenario, if you look at cash super conservatively, you end up with that $8 billion valuation if you fully net out their future convertible debt right now. But even in this floor scenario projection, you're looking at $600 million of new cash every year. So 600 million times these 4.5 years left is 2.7 billion in cash generated before you need to pay back this 1.5. And then you still have another 2 years before you need to pay back the 2.7. So it's 6.5 years, which is $3.9 billion generated in the floor case, right? This is the floor case net income. Floor case, you're looking at 3.9 billion generated by the time that you owe 4.2 billion, right? So even conservatively, when you're thinking about how you value their current cash position, well, they've got 9.3 billion in cash. A lot of people like to talk about their cash as if they only had the 5.1 of net cash. But the reality is, by the time you net out that cash, by the time you net out that 4.2, they will have earned at least 3.9, probably more than that. So is their net cash closer to 5.1 or is their net cash closer to 9? And if their net cash is closer to 9, well, then you take 9 plus the 1.35 and 1.45, and you end up with an $11.8 billion enterprise, assuming you don't value Powerpacks at all, and assuming you don't value the asset management business at all, which I would recommend that you do value them, right? But right now, GameStop is trading at what? A $9.1 billion market cap. 9.1 billion. So they're trading at basically net cash as it is. Not their current present literal net cash, but they're likely, by the time the cash is net cash, even in a worst case scenario. Right? It's kind of wild to think about. Of course, interest rates are going to come down, but the faster they come down, again, that's a tailwind for Bitcoin, and GameStop's cash pile is growing. So even if rates come down, if they're adding another 600 million to this cash pile every year through their own operating income, well, that's that much more cash. Like that's that's a huge portion of their cash position that then can generate more cash for them. So rates coming down is mitigated by the fact that GameStop's cash flowing so substantially. So is the worst case still intact? Is the floor still intact for GameStop? At these types of valuations, I would say yes, certainly. But we'll save some of that for a future video. Sorry for getting too into it today. This is how I would value the collectibles business right now, net of Powerpacks. Take Powerpacks out of it, you have a $4 billion fair value enterprise. Add it together, and you've got a $7.2 billion legacy retailer plus cash plus Powerpacks plus asset management position. So even in a worst case scenario, you still have a floor that is higher than your current trading price. It's a good place to be sitting. It's nice to be comfy. Nice to be comfy as an investor. Nothing's risk free, but hey, this is about as close as it gets on the open exchanges out there. All right, that's all I got for y'all today. I will see you in the next one.